What happens when debt grows faster than economies can sustain? Imagine a world where governments spend more on interest payments than on education or infrastructure, where inflation keeps eroding the value of savings, and where central banks are stuck trying to balance impossible trade-offs. That world isn't some far-off future, it's 2025, and it's happening now. Welcome to the debt reckoning.
The numbers behind this crisis are staggering. The U.S. gross federal debt has surpassed $36 trillion, including debt held by the public and intragovernmental accounts as of November 2024. This represents a debt-to-GDP ratio over 120% for publicly held debt, a level not seen since World War II. Globally, total debt levels have exceeded $300 trillion, with governments borrowing to historic highs to fund pandemic relief, energy subsidies, and infrastructure. Now, with inflation continuing to pressure households and economies in key regions, the cost of servicing that debt is spiraling, leaving policymakers with few good options.
This isn't just an abstract problem for governments, it's hitting households and businesses hard. Families are spending more on basics like groceries, rent, and gas, with inflation adding hundreds of dollars to monthly budgets. Businesses face higher borrowing costs, forcing them to delay investments or cut back on hiring. For anyone trying to save or invest, it feels like the rules of finance have changed.
And this problem is global. In Europe, countries like Italy and Greece are feeling the pressure as bond yields rise, making their massive debt burdens even harder to manage. In emerging markets like Argentina and Turkey, debt tied to the strengthening US dollar is becoming nearly impossible to repay. Even Japan, after decades of ultra-low interest rates, is grappling with inflation levels it hasn't seen in a generation.
The implications of this crisis go beyond economics, they're reshaping geopolitics and markets worldwide. Rising debt is driving nations like China and Russia to reduce their reliance on the US dollar, potentially challenging its dominance in global trade. And as central banks raise interest rates to fight inflation, they risk triggering recessions, leading to widespread uncertainty for investors, governments, and everyday people alike.
That's why today's episode is so important. We'll break down the forces driving this debt crisis, from inflation to shifting global power dynamics. We'll also explore how governments might respond, including some radical solutions that could change the rules of money as we know it. And most importantly, we'll share actionable strategies to help you navigate these turbulent times.
Whether you're an investor, a business owner, or someone trying to protect your family's finances, this episode is packed with insights to help you make informed decisions. We'll explore everything from inflation-resistant assets to geopolitical trends, giving you the tools to stay one step ahead.
And before we dive in, make sure you subscribe to Finance Frontier on Apple Podcasts or Spotify, so you never miss an episode. Follow us on Twitter for real-time updates, tips, and conversations about the global economy. Let's get started.
Debt and inflation have become inseparable forces, feeding off each other in a vicious cycle. Governments borrow excessively to fund spending, which increases the money supply and fuels inflation. To control rising prices, central banks hike interest rates, making it more expensive for those same governments to service their debt. The result? Even more borrowing to cover the costs, deepening the crisis.
We're seeing this cycle play out globally. In the U.S., debt to GDP has surged past 120%, a level not seen since the 1940s. But what's different now is the cost of borrowing. Interest rates have risen sharply, making it far more expensive to issue new debt or refinance old obligations. Meanwhile, inflation is adding hundreds of dollars to monthly budgets for everyday essentials like groceries, gas, and housing.
It's not just an American issue. In Europe, countries like Italy and Greece are grappling with skyrocketing bond yields, pushing them closer to fiscal instability as borrowing costs rise. Emerging markets are also under immense pressure. Argentina's inflation rate recently peaked at 209% before easing to 193% as of October 2024, sparking widespread protests and deepening economic turmoil. For countries reliant on dollar-denominated loans, the strong US dollar is compounding their problems, making it nearly impossible to service foreign debt without further strain.
For households, the effects of this cycle are deeply personal. A recent study shows that the average American family is now spending $400 more per month on basic goods and services compared to just 3 years ago. Social media is filled with posts about how inflation is eating away at paychecks. One user writes, "Every dollar I save feels like it's worth less the next day." Another asks, "How long can this go on before something breaks?"
Businesses are also feeling the pressure. Higher interest rates mean higher borrowing costs, forcing companies to delay investments or cut back on hiring. Small businesses, in particular, are struggling to manage rising input costs while trying to maintain competitive pricing. For investors, traditional safe havens like bonds are underperforming because rising yields erode the value of existing fixed income portfolios.
Central banks are grappling with their own challenges. The Federal Reserve in the U.S. recently adjusted its policy by lowering rates to a range of 4.5% to 4.75% after a period of aggressive hikes aimed at controlling inflation. While this shift signals an effort to support economic growth, it still leaves debt servicing costs elevated for both governments and corporations. In Europe, the European Central Bank faces an even trickier situation, balancing inflation control across 19 member states with vastly different economic conditions and debt burdens.
This feedback loop between debt and inflation is creating a no-win scenario. If central banks pause rate hikes, inflation could spiral further out of control. But if they continue, the risk of recession looms larger, threatening millions of jobs and pushing struggling economies closer to collapse. This is a challenge we haven't faced at this scale since the global financial crisis of 2008.
History shows us how dangerous this cycle can be. In the 1970s, the world grappled with stagflation, high inflation combined with economic stagnation. Governments and central banks were forced to take extreme measures, including record-high interest rates, to restore balance. The lessons of that era underline the importance of decisive action, but also the risks of overcorrecting.
The debt inflation loop doesn't just affect macroeconomic policies, it's reshaping how investors think about risk. Equities remain volatile as companies struggle with rising costs, while bonds, traditionally safe havens, are losing appeal due to climbing yields. Meanwhile, the surge in inflation is driving a renewed focus on tangible assets like gold and real estate, which often hold value better in turbulent times.
For investors, understanding this cycle is critical. It's no longer enough to rely on traditional strategies. This environment demands a proactive approach. In our next segment, we'll dive into the radical solutions governments are considering to break this cycle, from central bank digital currencies to debt monetization, and explore the risks these strategies pose to markets and individual wealth.
When traditional solutions fail, governments often turn to bold and untested strategies. In 2025, with the global debt crisis deepening, policymakers are considering radical ideas to stabilize their economies. These proposals may rewrite the rules of money and finance, but they come with significant risks.
One of the most controversial solutions is the introduction of central bank digital currencies, or CBDCs. Unlike decentralized cryptocurrencies like Bitcoin, CBDCs would be fully controlled by central banks. Proponents argue that CBDCs could streamline monetary policy by allowing governments to inject money directly into the economy or even restrict its use to specific purposes. Imagine receiving a stimulus check, but you're only allowed to spend it on groceries or medical bills. While this level of control might help manage inflation, it raises serious concerns about privacy and government overreach.
Another strategy under discussion is debt monetization, where central banks print money to pay off national debt. It sounds simple, but the risks are enormous. In the 1920s, Germany used this tactic to address its war reparations, leading to hyperinflation so severe that citizens needed wheelbarrows of cash to buy a loaf of bread. While modern economies have more tools to manage inflation, the potential for destabilizing currency markets is still very real.
Austerity is also making a comeback. Governments under pressure to reduce deficits are cutting public spending, often targeting welfare programs, pensions, or infrastructure projects. This strategy, though effective in reducing debt, can slow economic growth and trigger social unrest. We saw this during the European debt crisis, where austerity measures led to mass protests and long-term economic stagnation, in countries like Greece and Spain.
Emerging markets are taking a different approach, de-dollarization. Countries like Russia, China, and members of the BRICS coalition are actively reducing their reliance on the US dollar by developing alternative payment systems and exploring regional currencies. For example, China's Belt and Road Initiative has encouraged trade partners to settle transactions in yuan. While this reduces their vulnerability to US monetary policy, it also introduces challenges. A regional currency, for instance, would require trust and cooperation between nations with competing interests, something that's easier said than done.
Critics of these radical solutions are raising alarms. CBDCs, while efficient, could hand central banks unprecedented control over personal finances, potentially eroding financial freedom. Debt monetization might provide temporary relief, but risks igniting inflationary spirals that could erode savings. Even austerity, often considered a safe option, can deepen inequality and weaken long-term growth.
On social media, the debate is fierce. One user writes, CBDCs might solve inflation, but at what cost to privacy? Another asks, are we just printing money and hoping for the best? This feels like a disaster waiting to happen. These discussions reflect widespread uncertainty about whether these strategies will fix the problem or create new ones.
Meanwhile, businesses are responding to these potential changes. Tech companies, especially those in the fintech sector, are closely watching CBDC developments, which could redefine how payments and banking operate. Commodity traders are preparing for shifts in global trade as de-dollarization efforts accelerate. And industries reliant on government spending, like construction and healthcare, are bracing for the impact of potential austerity measures.
For investors, these solutions represent both risks and opportunities. CBDCs could disrupt traditional financial systems, creating opportunities for innovation but also introducing regulatory uncertainty. Debt monetization might inflate markets in the short term but erode real returns over time. And de-dollarization could shift currency markets in unpredictable ways, impacting global investments.
In our next segment, we'll explore how you can navigate these challenges as an investor. From inflation-resistant assets to diversification strategies, we'll give you the tools to protect your wealth and thrive in an era of economic uncertainty.
In a high-debt, high-inflation world, traditional investment strategies need a serious rethink. With central banks grappling to control inflation and governments exploring radical solutions, the stakes for investors have never been higher. But there are ways to protect your wealth and even uncover opportunities amid this uncertainty.
Let's start with inflation-resistant assets. Treasury inflation-protected securities, or TIPS, are designed to safeguard your portfolio against rising prices. Unlike traditional bonds, TIPS adjust their principal value with inflation, ensuring your returns keep pace. While their yields may be modest, they provide a stable foundation for conservative investors looking to minimize risk.
Gold is another reliable hedge. Known as a safe haven asset, gold typically performs well during times of economic instability. Recently, gold prices have climbed above $2,600 per ounce, reflecting renewed interest from investors. Whether through physical gold, gold-backed ETFs, or mining stocks, this asset remains a cornerstone for protecting against currency devaluation.
For those willing to explore alternative options, commodities like oil, agricultural products, and industrial metals offer another avenue. These assets are directly tied to economic activity and often rise in value alongside inflation. Energy ETFs, for example, allow investors to gain exposure to oil markets without the complexities of direct commodity trading. Similarly, agricultural commodities provide tangible value in volatile markets, making them a stable addition to diversified portfolios.
Real estate also deserves attention. Historically, property values tend to rise with inflation, offering both appreciation and rental income potential. While rising mortgage rates can make new investments more expensive, focusing on high-demand regions can yield strong returns. For current property owners, inflation works in your favor, often increasing rental income and asset value over time.
For a more defensive approach, consider stocks in sectors like healthcare, utilities, and consumer staples. These industries provide essential goods and services, making them resilient even during economic downturns. Defensive stocks may not offer explosive growth, but they provide much-needed stability in a volatile market. Shifting from high-growth tech to these sectors can help balance your portfolio during uncertain times.
Diversification is another crucial strategy. By spreading investments across asset classes and geographic regions, you can reduce overall risk. Emerging markets, while riskier, often offer higher growth potential. However, it's essential to focus on politically and economically stable regions to avoid compounding risks. Geographic diversification can also help shield your portfolio from domestic challenges like inflation or currency devaluation.
Cryptocurrencies, while controversial, have gained traction as a potential hedge against traditional market instability. Assets like Bitcoin are often referred to as digital gold, appealing to younger investors seeking alternatives to traditional inflation hedges. However, the crypto market remains highly speculative and susceptible to regulatory changes, making it a high-risk, high-reward option that should be approached with caution.
No single strategy will suit every investor, but building a resilient portfolio is essential. Start by evaluating your current holdings. Are you overly reliant on stocks or bonds? Could you add inflation-resistant assets like tips or commodities? And are you exposed to regions or sectors that are more stable than this environment?
In this economic climate, adaptability is key. By balancing defensive and growth-oriented assets, diversifying geographically, and staying informed about market trends, you can protect your wealth and even find opportunities for growth. In our next segment, we'll zoom out to explore how these strategies align with the shifting geopolitical landscape, including the rise of alternative financial systems and de-dollarization efforts.
The global debt crisis isn't just reshaping economies, it's redefining the balance of power between nations. As governments grapple with record-high debt, the policies they adopt today will have far-reaching implications for trade, currency dominance, and geopolitical alliances.
One of the most significant shifts is the move toward de-dollarization. For decades, the US dollar has been the backbone of global trade and finance, but that dominance is being challenged. Countries like China, Russia, and members of the BRICS coalition, Brazil, Russia, India, China, and South Africa, are actively working to reduce their reliance on the dollar. From creating regional payment systems to settling trade in alternative currencies, these nations are exploring ways to insulate themselves from US monetary policy and economic sanctions.
Take China, for example. Through its Belt and Road Initiative, China has been encouraging trade partners to settle transactions in yuan rather than dollars. Russia, meanwhile, has been stockpiling gold and shifting away from dollar reserves to protect itself from sanctions. These efforts, combined with growing trade partnerships among BRICS nations, signal a deliberate effort to weaken the dollar's role in global finance.
But de-dollarization is easier said than done. The dollar remains deeply entrenched in international trade, accounting for nearly 60% of global foreign exchange reserves. Creating a viable alternative would require not just economic alignment, but also political trust, a rare commodity among nations with competing interests. For instance, a BRICS currency would need to address disparities in economic stability and governance between its member countries, which is no small feat.
These shifts aren't just about currencies, they're reshaping global trade dynamics. With rising inflation and debt making imports more expensive, some nations are turning inward, prioritizing self-sufficiency and regional trade. Southeast Asia is strengthening intra-ASEAN trade ties, while African nations are boosting collaboration through initiatives like the African Continental Free Trade Area. These regional alliances aim to reduce reliance on external markets and stabilize local economies.
Meanwhile, developed economies face their own set of challenges. In Europe, high-debt nations like Italy and Greece are once again under scrutiny, as rising bond yields increase the cost of borrowing. Germany, typically the EU's economic anchor, is grappling with inflation that's eroding consumer spending. In Japan, decades of deflation have given way to inflationary pressures, forcing policymakers into uncharted territory.
Emerging markets are particularly vulnerable. Countries like Argentina and Turkey, heavily reliant on dollar-denominated debt, are struggling to service their obligations as the dollar strengthens and interest rates rise. Argentina's inflation rate recently topped 100%, fueling protests and economic instability. These crises underscore the delicate balance between debt management and economic growth in emerging economies.
The geopolitical landscape is shifting as well. Rising debt and economic uncertainty are driving nations toward more protectionist policies. From trade tariffs to subsidies for domestic industries, these measures are reshaping global supply chains. While they may provide short-term relief, they risk fragmenting international trade networks, potentially slowing global economic recovery.
For investors, these global shifts present both risks and opportunities. The rise of regional currencies and trade alliances could disrupt foreign exchange markets, creating volatility but also opening up new investment avenues. Similarly, protectionist policies may favor certain domestic industries while disadvantaging global players. Understanding these trends is critical to navigating the evolving economic landscape.
In our final segment, we'll recap the key takeaways from today's discussion and share actionable steps to help you prepare for the challenges ahead. Whether it's building a diversified portfolio or staying informed about geopolitical trends, we'll give you the tools to thrive in a changing world.
As we bring this episode to a close, let's recap the critical insights we've covered. The debt reckoning of 2025 is more than just a financial crisis, it's a structural shift reshaping economies, markets, and geopolitics worldwide. From rising inflation and debt servicing costs to radical policy proposals, the challenges are immense, but so are the opportunities.
We started by exploring the debt inflation feedback loop, where governments borrow to fund deficits, fueling inflation that makes debt even harder to manage. This vicious cycle is putting pressure on central banks, businesses, and households alike. For families, it means higher costs for essentials. For investors, it demands a shift in strategy to protect wealth.
Next, we looked at the radical solutions being debated in the halls of power. Central bank digital currencies, debt monetization, and de-dollarization could redefine global finance, but also carry significant risks. These ideas might stabilize economies in the short term, but they challenge long-held principles of monetary policy and financial autonomy.
Then we turn to actionable strategies for investors. From inflation-resistant assets like TIPS and gold to geographic diversification and defensive stocks, we outlined ways to build a resilient portfolio. We also highlighted the importance of adaptability in navigating this volatile landscape. In today's world, no single strategy guarantees success, but a balanced approach can help mitigate risks.
Finally, we examined the global impacts of this crisis. The rise of de-dollarization, shifting trade alliances, and protectionist policies are transforming the economic landscape. Understanding these changes isn't just important, it's essential for staying ahead in a rapidly evolving world.
So what can you do next? Start by evaluating your financial goals and risk tolerance. Are you prepared for rising inflation? Have you diversified your portfolio across asset classes and regions? And are you staying informed about global trends that could impact your investments?
And don't forget to leverage the tools available to you. Financial advisors, market research platforms, and community discussions can provide valuable insights. This isn't a time for complacency, it's a time for action.
Before we go, make sure you subscribe to Finance Frontier on Apple Podcasts or Spotify, so you never miss an episode. Follow us on Twitter for real-time updates, tips, and conversations about the global economy. And share your thoughts using #FinanceFrontier. We'd love to hear how you're preparing for the challenges ahead. The opinions expressed in this episode are those of the hosts and may not necessarily reflect the views of our affiliates or sponsors. Past performance is not indicative of future results, and all investments carry inherent risks, including the potential loss of principal. Always evaluate how this information applies to your individual financial situation.
This episode drew on data and perspectives from trusted sources like Bloomberg, Reuters, and expert commentary to deliver the most accurate and timely analysis possible. However, we encourage our listeners to stay vigilant and informed as market conditions continue to evolve.
Thank you for tuning in to Finance Frontier. Music in this episode, including Not Without the Rest by Twin Musicom, is licensed under the Creative Commons Attribution 4.0 license. Finance Frontier Copyright 2024. Unauthorized reproduction or distribution is prohibited. We look forward to having you join us again next time.